Alright, in this video I'll demonstrate how to go pull the data that we want pulled for the other 6 companies besides Target. I'll go ahead and pull Target, and then you'll have the data up there to look at, so when in doubt you can always go back and look and see where that came from. Alright, so we're going to use Yahoo Finance, so pretty easy. Type in finance.yahoo.com. There's a quote lookup box, and I'm going to do Target. I know it's TGT. I'm going to type in TGT and wait for the box to pop up. Alright, since I've already looked it up, I'm going to cheat and go ahead and click on the link. This runs slowly, and so patience is always required. Alright, so for Target Corporation, some of this data you could grab from the front page here. For example, the beta is on the front page, but it's also on the statistics page. Most of the data we're going to pull is from the statistics page. And you can find the beta there. We'll shrink this enough so it shows up on the beta shows up here in the second column over beta 5-year monthly data. Okay, so some of the other data again is on this summary screen. So between the summary, which is the tab at the left, the statistics, the analysis, and the financials, you can get all the data we're looking for. Alright, so I need to get the beta, and that's 0.56. I can get it from the front page here. Note that when I plug that in, the green cells will automatically calculate something. Alright, so it's automatically calculating. It's automatically calculating the expected rate of return under the cap M. The current price, this would have been the price at closing on Friday, February 7th, 11561. So whatever day you look this up, that's the day you want to pick that out. If I want to go ahead and get the forward annual dividend rate, go to the statistics page, and forward annual dividend rate is $2.64. I want the earnings per share growth. That is in the analysis block. Go down here towards the bottom. Next 5 years per annum, 10.15%. Alright, so analysts have, that's their consensus estimate. Notice that there's a radical difference between the rate of return under the discounted cash flow model and under CAPM. That's just normal. And what you're going to find is that the formulas and stuff that finance people talk about got to be modified. So anyway, this is a little real world 101. Going back to this stuff that we're going to pull here, go into the statistics tab. I can start getting the other data. The market cap, 58.58 billion. Everything should be in millions. Enterprise value 71.68, 71,680 is at 71 billion in millions. The trailing PE ratio 1849. The forward PE 16.80. Enterprise value over revenue 0.92. Enterprise value over EBITDA 9.95. Net income available to shareholders. Net income available to common shareholders trailing 12 months, 3.23 billion, be 3,230. And shares outstanding. So over here in the second column, shares outstanding, 506.74 million, 506.74 million. That'll actually go ahead and calculate my earnings per share. And now I want book value of assets, liability, and equity. If I go over here and look at the financials, I want the balance sheet and use the data from the most recent filed information. So when you get the balance sheet, choose quarterly and use the most recent quarter. Total assets, everything here is in thousands, so I dropped the last three zeros. 43,741. So it's 43,741 millions, or 43,741 million. The book value of liabilities, total liabilities, 32,196. Make sure you get total liabilities, not the current or the non-current, total liabilities. And then total shareholders' equity is 11,545. All right, the market value of the assets would be the sum of the market cap, which is the market value of equity. And we're going to use the book value of liabilities as the market value of liabilities because it's usually pretty close. Notice that the market value of the assets, which would be the sum of the market value of the liabilities and equity, is twice the book value of the assets. And the main reason for that is that the market value of the equity is 5 times the size of the book value. With large publicly traded corporations, that's just the way it is. Book value grossly understates the market value of the company. What we can see is some of these common metrics like return on equity based on book value, 28%. It's only about 5% based on the market cap or a market value of equity. If we look at the debt ratio, it's about 73.6% based on book values. On market values, it's a lot smaller, so they don't use near as much financial leverage once you convert the equity values to market values. All right, from all that, once you fill in the entire table here, use the information provided to try and make a choice between Target, McDonald's, Home Depot, Caterpillar, Procter & Gamble, Johnson & Johnson, and Delta. Assuming that the investor already has a diversified portfolio, he's got money to add and wants to know which one of these 7 companies would you recommend as part of a diversified portfolio. They're all dividend paying stocks as well. So keep in mind that you've been asked for advice for somebody else on which of these 7 would be your recommendation based on the metrics.